Okay, so let's get started with building out our understanding of the underpinnings of the Forex market. And let's try to establish a really solid foundation and understanding of the currency markets. So the first thing we're going to have a look at here is we're going to try to understand what the Forex markets are all about in their basics. And what you're going to find is that there's a lot of what we call noise in the Forex market, more so than probably any other asset class. What do we mean by the noise? Well, what we mean is basically the participants. So companies and people within the Forex market that have inherent conflicts of interest to your own objective, which is to make money using your own money. And these participants that perpetuate the noise, really, they divert your attention away from your objective in order to get themselves paid. And what you're going to find is a lot of brokers and educators in the Forex market, they're no different in the Forex market than any other asset class. In fact, they're probably even worse than in other asset classes. And once you start really understanding what their objectives are and how they're counterintuitive to your own objectives, you're going to begin to understand what the true underpinnings of the retail trader Forex market actually are. And you'll be able to cut through all of this noise and the BS perpetuated by these players with their inherent conflicts of interest. What do we mean by the conflict of interest? Well, what we mean is actually the people and companies that get paid on a volume basis. So they get paid a commission based on the amount of volume that trades in a particular market. So once you understand how this conflict of interest is against all of your own objectives, you're going to understand and know the difference between what is probably true and what is false in the markets. And that's going to really help you to avoid all of the retail Forex trader mistakes. And it's going to stop you losing money. So becoming part of what we call the 90-90-90 in the Forex markets, which is 90% of retail Forex traders lose 90% of their money within 90 days. And it's going to protect your downside. And the 90-90-90 phenomenon is something that we talk about a lot in the Institute. The vast majority of retail Forex traders actually lose most or all of their money in a very short space of time. And it's absolutely 100% true. We have a lot of statistics in the Institute that we look at, and we've seen the 280,000 trading accounts in the Forex market, in the retail Forex market across all the retail brokerage platforms. And 90% of these accounts, plus over 90%, are actually down. They lose pretty much all of their money in a very short space of time. And once you start understanding the reasons why, this is going to help you protect your downside. One of the reasons is that there's a lot of noise. And as professional traders, what we try to do all the time is to seek out, in any market, we seek out volatility. And once we start actually looking at how the Forex market is organized, so once we start looking at how we organize the world's currency markets versus how the participants with conflict of interest actually organize the world's currency markets, we start to see that this organization and the definitions of currencies are actually different to our own. And the first thing we look at, for example, is how brokers and investment banks actually define currencies. Because what we want to do is start organizing in a professional trader way and really focus on volatility. And when we look at the way the popular media, so this is the outlet for all the noise. So we're talking about television, newspapers, and online media. When we look at the way the outlet, the media, organize and structure the definitions of currencies, we realize that they're very different to a volatility analysis. So you might think here, for example, why are we looking at investment bank definitions? Well, investment banks are really institutional brokers. They do business with hedge funds and pension funds, mainly on the secondary market side. And in the Forex markets, their clients, the hedge funds and the pension funds, trade currencies via the investment bank and pay a spread or commission. They pay the spread on all of the currency pairs that they trade. And investment banks are simply just the institutional side of retail brokers. So essentially, they're just institutional brokers. They're market makers. They also do have proprietary trading operations. And what's actually quite surprising is that the proprietary trading operations in investment banks would take the same approach that we take, which is different to the approach that the market making side of the investment bank would take in defining currencies. And the way currencies are defined at investment banks and retail brokers, the way these guys define currencies is very much counterintuitive to a professional trader objective, which is to make money using our own money. So what you're going to find with investment banks, retail brokers, and media is that currencies will be grouped very much dependent on the size of the currency. What do we mean by the size of the currency? The amount of volume that trades per day, the most popular currencies. So the first definition you're going to see is the G10, the group of 10 currencies. And what we've got here is the classic definition of G10, which is the US dollar, euro, Japanese yen, British pound, Swiss franc, Australian dollar, New Zealand dollar, Canadian dollar, Swedish krona, and Norwegian krona. And you're going to notice here that we've got the letter C next to 4 of our currencies. So the letter C, for example, is next to Australian dollar, and the letter C actually stands for commodities. The reason why we've marked these up with a letter C next to them is because our objective is to figure out what has the most potential volatility, what has the least potential volatility, and we want to know what these currency values actually depend on. So what we've done is we've marked here the currencies within the G10. We've marked them with a C because the value of their currency is dependent, or very heavily dependent, on the price of international commodities. So just 1 or 2 particular commodities. And these differ, for example, from the US dollar, euro, yen, pound, Swiss franc, Swedish krona. They differ slightly because the other currencies don't depend solely on 1 or 2 commodities. So the prices of their currencies don't depend heavily on the price of 1 or 2 of their exports. And the bigger currencies, the US dollar, euro, Japanese yen, pound, Swiss franc, Swedish krona, these currencies that don't depend on the 1 or 2 commodities, those currencies are more diverse in their exports. And when you think about this, if a currency value is heavily dependent on 1 or 2 commodities, relative to another that is very diverse in its exports, it's pretty obvious that it's more likely that the commodity currency is going to be potentially more volatile because it depends on just one or two factors rather than a multitude of factors. So we mark these up with a C to begin with. Investment banks will group all currencies together as G10. So will retail brokers. And that's basically to divert your attention away from what really matters, which is volatility. They're trying to group them all as one basket, dependent just solely on the size of the transactions that occur every day in the Forex markets. The other definition that we look at with investment banks, retail brokers, is in emerging currencies. So we're talking about countries here whose economies are small and growing at a high rate, or should be growing at a high rate, and they're defined as emerging currencies. Emerging currencies, typically within investment bank definitions, retail broker definitions, are split up into EMEA, so Europe, Middle East, and Africa, Gulf, so Gulf Cooperation Council, GCC, and also on the next page, Asia. And what you see here is that we've marked up again a bunch of these currencies with a letter C because they're dependent very heavily on just one or two commodity prices. So the value of their currency depends very heavily on one or two commodities because it's a very big proportion of their exports. And over here on the right hand side, we've got the GCC, and with the GCC currencies, all the Middle East currencies, you can see that they are all dependent on one or two commodities. And you can also see we've marked them up with a P. The P stands for pegged, and this is a Forex regime. We're going to look more closely at Forex regimes in video number 2. But for now, we just need to know that there's two main Forex regimes. The first one is a floating regime where a country's currency has the ability to float freely against all other currencies in the world. And the second main regime is a fixed or pegged regime where the value of a currency is fixed or pegged to the value of another or to a basket of other currencies. Usually the basket is made up of the main trading partners of the country's export market. So we should know intuitively that in the Middle East, the commodity we're going to be looking at is the oil price, so oil exports of the Middle East. But we also have to be aware that all of our Middle Eastern currencies are in some way pegged to another currency or a basket of currencies of their trading partners.